Move on to a slide like PSG, and you can see how the fortunes are mixed between all the different fund managers. In this case, we've been referred a lot of clients from PSG, as I mentioned, and you can see the performance. Just to recap, minus 15.56% over 1 year, over 3 years 2.41 minus, and 1.43% only for the last 5 years. So you can imagine if you're an investor, you'll be selling off units. You wouldn't be able to survive on 1.43% in the last 5 years. You would have had to sell off units to survive with that type of performance. So that's why we had big buckets of money to give our clients high income, focusing on other high income funds that we've selected. Just to show you how bad the market really has been, bad in inverted commas. Here's Alan Gray that people have been following, that hasn't beaten the index, as I mentioned, in the last 10 years in one of my previous presentations. Over the last 10 years, this fund only gave 7%. Again, cash beat it. Yes, there is tax on interest that you earn, but spare a thought for the last 5 years, minus 1.2, minus 6.4, minus 11% over 2 years, and almost minus 25% over the last calendar year to date. So really, you can see that your experience wasn't in 1999. What your experience is here. Your experience over the last 10 years has been less than the index. And another quick example is Foot Equity, another value fund manager. You can see they've also struggled. If we look at the last 7 years, 3.3%. Over the last 5 years, minus 3.8%. And over the last 3 years, minus 5.8% again. The last 12 months, minus 11. So equity fund managers generally have battled in this market. The local economy has been in an L-shaped. It has not gone anywhere. In fact, it's going down slightly. And the same with Coronation Top 20. They look at the top 40 shares and they buy the top 20 shares. And again, you can see a very mixed bunch. I'll quickly read one result out to you over here. The active return over the last couple of years, again, flat to negative. So these slides are available for you to look at. Let's see where we're going though. Where are people feeling? Where were we on the curve? It's important to be proactive and not reactive. So investors, we're very proud at Babich Associates, Edwin and myself. We've been where the smart money is. The smart money said in the beginning, the stealth phase. We could see this L curve happening. An L curve was happening. We could see the markets weren't going anywhere. So what we did is we, as I said, moved our clients' money out of those funds that I mentioned, some of them. Institutional investors, that's the big fund managers, the pension funds, also started to do stuff. There was a first bit of a sell-off. That's what we call a bear trap. And then of course here, for the average investor, the public, you can see they were climbing into the markets. They were very happy, particularly overseas, until we hit this new paradigm. Let's call it paradigm 3, which is the COVID-19 pandemic. Whether people are in denial or we're going to return to the normal, we don't know where this market's going to go. It will recover at some point, we do know that. How quickly, we don't know. So would it be a bear trap? But then what will happen is if people are feeling despondent, we'll have fear, capitulation, and despair. And then hopefully we'll have a return off to the medium, to the mean. At the moment, we're in a bit of a mania phase. I think we've got to be careful. We've been bombarded with so much information on CNN and news clips from Mayor Cuomo or Governor Cuomo in America. We get so bombarded with all this negativity. This is a virus, yes. We are feeling perhaps anxious, etc. But the truth of the matter is, at least 95 to 99% of people will survive this. The vast majority, it's been statistically shown that only the mortality rate is actually exceptionally low. We just don't know how it will affect certain people. We looked at Boris Johnson as one example, or one of the Olympic swimmers, the South African Olympic swimmer that had his video go viral. We do fear that because we fear that could be us. But the truth of the matter is the fallout for the economy is going to be far worse than the actual pandemic, in our opinion. And we think that this is going to last for longer than people think. Right. So our market analysis, very, very quickly. We won't go into this too great a depth. We feel that at the moment, with 30 million people losing their jobs, the market recovery is not going to suddenly just go up. We're not going to see We don't think we'll see a V-shaped recovery. At best, we'll see probably a U-shaped, a protracted U-shaped. Hopefully we don't see a dreaded L-shaped that we've been having here in South Africa. You can see massive stimulus coming in. The emerging, the central banks have been pumping trillions, literally, of currency, dollars and Japanese yen and euro into the market. You can see that the Fed, the American Fed, has pumped in over $2 trillion worth of stimulus. There's European central banks and the Bank of Japan collectively. There's over $5 trillion worth of money being printed, quantitative easing as they call it, to help prop up the economy. So this has been unprecedented. As I said, it's the world's largest financial experiment. And what you can see though is that the earnings per share growth forecast that given all the stimulus is looking very muted. You can see in America, the emerging, the European emerging markets, the global markets, Europe and Japan, you can see that the earnings per shares are down. So we don't think the market's just going to, as they would say, summer just bounce back. Although you've got this massive stimulus, printing of money, what's happening with the real economy? Are people going back to work? Are people consuming? Are the manufacturing sector coming online again, etc., etc. So look, I think caution is always the better part of valor. Some crazy anomalies happening here where you've got oil prices in negative territory. If you told me a year ago that oil prices would be going back to, in real terms, adjusted for inflation, back to 1870 prices, 1870, ladies and gentlemen, you can see the oil prices have dropped dramatically in real terms. From that amount, the cost of a barrel of oil, it's dropped right down to negative territory. The cost of a barrel of oil in nominal terms has dropped dramatically. And you can see what the impact it's had on companies like Sasol, etc. So oil at $20 a barrel, almost unbelievable. And we can't even go to the pumps and fill up our cars right now because we're all in lockdown. And I've never seen the sky so blue with no planes flying. So I guess Mother Nature's the winner. From us consuming less oil, I guess Mother Nature's the winner here for sure. Let's go to government bonds quickly. Out of interest, look at government bonds in Germany, United Kingdom, France, all these numbers. Germany, negative 10-year bonds. If you go to places like France, almost flat. Italy, 2%. Spain, 1%. Netherlands, negative. Portugal, 1.19. Even Greece, 2.34. Nothing spectacular. Switzerland, negative. So your government bonds are not doing that great. So our bonds, our government bond yielding, as I said earlier in the presentation, about 10 and a bit percent versus negative to flat rates overseas. You can see why it might be attractive even though we've been junked. Talking about the styles of fund managers, this talks about the style heat maps. Where you see red, it's a bit like coronavirus scanning. When you feel you've got a temperature, this graph tells you that value fund managers like Alan Gray, not looking good. Whether it's book to price, dividend yields, earnings yields, cash flow, sales to price, the value fund manager style, big red no-no there. Then you've got quality, people are running back to quality shares or even growth shares or momentum shares. Right now, you want to be where the yellow is. You want to have, where the green is. Low debt, low borrowings, equity. Those quality shares, companies that have got low debt and a good balance sheets, they're the ones, the quality companies that are going to do well in this market. So wherever you see green, that's where. Income, have they got good cash flow? So definitely we don't think it's a value market right now. It's back to quality. Growth, going to be pretty subdued. Momentum and growth. Your big 5 companies in America like Amazon and Apple and Netflix, those are the momentum stocks that are going to do well. As I mentioned, quality stocks. Stay away from the red area. Well, I don't think much more I can say about developed and emerging markets. You can see that emerging markets and developed markets, you can see emerging markets fared worse than developed markets. South Africa's an emerging market over there. If you followed the caps wicks and you measured it in dollars, our market's down 38% because of the dollar-rand exchange rate. So emerging markets, unfortunately, came under a lot of pressure. And you can see this fall off from December all the way to March. The bottom line, emerging markets in dollar terms, not looking great. So if you had money overseas, even with the sell-off, you've probably done okay. As I said, we think that the sweet zone right now, despite us being jumped, is the 10-year bonds or the 7-year bonds even. We're getting yields of 10%, over 10% when we did this slide. So you can compare that to developed markets where their 10-year bonds were giving you virtually nothing to negative. So we'd have to see our currency go down by another 10% to match what we're getting for the risk return here in our bonds is still quite compelling. But we'll have to see how our government handles this crisis. In terms of over a 1-year period, that was a three-month viewpoint. In terms of a year, not as bad looking over 1 year. Let's go to the 3-year slides. 3-year rolling periods. You can see at 8.41%. Funny enough, resources looking quite good with their rand hedge qualities. So resources, believe it or not, which were the absolute dog of the market, actually not looking too bad comparing to industrials and of course financials, banks, etc. faring the worst. Banks and insurance companies not doing well, they're in negative territory. But interestingly, resources suddenly recovered quite a bit. And that's helped largely, of course, for things like platinum and gold. In terms of the markets decomposed, the winners and the losers, you can see all the areas here: oil and gas, forestry and paper, all these different markets, life insurance, general, industrials, etc., all the way down to the banks. You can see what sectors, I needn't tell you, travel and leisure down 55% over there. So things like industrial engineering down 64%. So the last few months you can see what happened, how devastating the lockdown has been to the manufacturing sector, the construction sector, and the leisure sector. They've been the worst affected. We don't foresee, Edward and I are dealing with some of the airline people, we don't foresee SAA obviously making it, which is probably a good thing. Like all viruses, the survival of the fittest, which will survive and which won't. Over the last year, that was 3 months, if we go back to 1 year, you can see again which did the worst and which did the best. Again, industrial engineering, etc., travel and leisure, all these ones all battling. It seems the winners at the moment are, believe it or not, even though we've got this ridiculous smoking ban, tobacco still was looking pretty good. But generally, it's been a pretty bleak year for the last 12 months. That's why we're very proud of our results over the last 12 months. Our average client has actually held their capital value less drawings. So I think that's quite remarkable against this backdrop. And in terms of markets, the market caps, the small caps have fared the worst, as you'd expect. The small companies, the companies that are not exporting overseas, etc., the small caps have suffered the most compared to, say, the large caps, which have done the best. No real surprise there. In terms of local asset classes, the winner here, Steffi, fixed interest. Cash was the winner over the last 3 months. And clearly at the bottom there, listed property, a complete blowout at minus 48%. Almost lost half its money. People are not going to pay their rents, etc. So listed property, not great. So in conclusion, global assets in terms of bonds, etc., the real money to be made was in things like fixed interest overseas, where you've made your money on rand depreciation, dollar appreciation, etc. You definitely haven't made money in emerging economies. They've battled through this crisis. So without going into too much more detail, fixed interest was the place to be. Fixed interest was the place to be there, 7.2%. Property was not where you wanted to be. And the bonds managed to survive. The All Bond Index wasn't too bad over there. If you see the All Bond Index, not too bad. There's inflation there. There's fixed interest. There's bonds. So if you had a portfolio of bonds and cash, you did fairly well. And with the yields now at over 10% of the 10-year bond, we think that's going to be good for our clients with an overlay of offshore assets perhaps. I won't go into more about the global asset mixes, etc. I'm going to just skip through these slides over the last 5 years. What I want to concentrate right now is what happened over the last 5 years. You can see that the US dollar versus the rand didn't look so bad there. It was only depreciating at about 7.9%. So if we look at the 5-year period in March 2020, the rand dollar wasn't doing too badly, 7.9%. So if you put your money in a bank in South Africa, let's say you got 8%, which you could have, and the currency depreciated by 8%, you were actually doing okay. Because remember, overseas bank accounts, you didn't earn much. But of course, that all fell by the wayside when the foreigners just sold everything recently that they could to gain liquidity. And of course, that blew out the rand dramatically. But over a 5-year period, it was looking quite respectable. Anyway, without going into all these graphs, these show the winners and the losers. At the top there at 15%, you can see that, things like fixed interest, etc., no surprise. And certain equities did very, very well. In terms of the currencies, it's always a difficult one to predict. You can look at the sterling and the rand, you can look at the euro and the rand and the dollar and the rand, between 20 to 27% depreciation. That's unbelievable. In my 27 years, I've never seen a currency fall as hard as that, but we're living in unprecedented times. As I said, we do think the rand has the potential with purchasing power parity to come back. So the danger here is people now rush overseas in panic. They buy at current exchange rates. They go and buy into expensive American market. And then what could happen, the rand could strengthen and offshore markets could carry on going down. So if you go and buy equities overseas and they come down and the rand strengthens, you may have a surprise of a double whammy. And I've seen this happen 3 times in my career, where people rush overseas, think it's all doom and gloom at home, nothing's going to happen. We're doomed to a basket case. And then, of course, the rand surprises everyone and comes back. Will that happen? Well, let's see. Maybe this time it's different. In terms of the rand gold, all those gold pundits, you can see gold going up. This is going back to March 2010, gold going up, and then gold going down in March 2014, then up, and then down, and now gold being very, very in vogue at the moment. So that's gold. The gold bulls are back. I think it might be overbought at the moment. I don't think the world economy is going to collapse as we know it. So with all this $5 trillion stimulus, perhaps gold as a safe haven, who knows. But I know for many of my clients, gold, Kruger rands, etc. are important. So gold price, certainly if you've held onto your gold coins, they're looking quite attractive. And then, of course, you've got all the different, you've got oil, you've got gold, you've got iron, you've got copper, palladium, platinum, etc. You can see the winners and the losers on that side as well. But you can see oil right at the bottom there, not looking great. Commodities are at the bottom. The star at the top, gold, and then followed by things like palladium, etc. So if you want to buy commodities, that's the story there. Our funds do hold commodities, by the way. In terms of panic, in terms of what we call the VIX measures volatility. It's a volatility index. Going back to 2010, you can see the coronavirus, people's panic has been at all-time highs. The VIX measures people's fear, people's panic. And you can see all the different uncertainty periods, and all of a sudden, this massive spike up in what's happening in people's concerns and volatility. So it's a measure of volatility, pretty scary stuff there. But I don't think there's need to be panic. At some point in the next 24 months, I believe a vaccine will be found. The herd immunity will start building up and things will start to normalize. The trouble is, how quickly can we get those lost jobs back? There's 30 million people in America. How quickly will the world economy get back on its feet? Your guess is as good as any economist right now. So in conclusion, lots of selling off from South African point of view, foreigners selling off our bonds, selling off our equities, selling off our rand dollar. Our rand dollar not looking pretty. And in terms of transactions and equities, the foreigners are selling off equities. We've had billions of dollars leave South Africa, and that's what's put massive pressure on the rand. Could this money come back? That's the question. Back into the bond market, etc. But you can see the foreign transactions, particularly in 2020, 60 billion or almost 80 billion rands worth of cumulative foreign transactions in the bond market, that big sell-off, forcing the South African Reserve Bank to intervene and start buying bonds to create liquidity back in the market. Massive big sell-off there. So what is our conclusion? Our conclusions are as follows. Just briefly, a slow recovery possible in the world, the global economy. A U-shape for US would be the best outcome. We don't think there'll be a V-shaped recovery. It might be a slow U-shaped recovery. Again, you can have 10 different economists and you'll have 10 different opinions. But we believe, from a common sense point of view, that the job market won't just suddenly bounce back miraculously. It's going to take a while for the job market to get back on its feet again. So we think hopefully the best case is a U-shaped. A recession locally, L-shaped. We've been in a recession. Our markets have been going nowhere for the last 10 years. Our socio-political climate, our borrowings, our fiscus, it's all pretty shot at the moment. So we don't think we're going to see a massive recovery locally. Offshore equities are still more attractive than overseas. Be careful though, there's a potential for a W false recovery, so caution is needed. Remember, the market goes down, then it recovers as it's done. It could go down again. We call that a W recovery. So will it be a U, an L, or a W? Your guess on the alphabet is as good as any, but we think these are the likelier of the three, the U and the L. But if they don't get things right quickly in America, we'll definitely see another dip coming down. We think there's too much fake money around, divergence between the real economy, the building of roads and bridges and hospitals, the real economy comprising of actual goods and service, and the virtual economy like Bitcoin, negative yielding bonds, hedge funds, derivatives, credit. There's $20 trillion worth of negative yielding interest-bearing monies out there. So you've got all this fake money versus the real economy. There's a total disconnect between the real economy and what we call the fake economy. Fixed interest investments locally relatively look appealing for now, just for now, particularly probably in the 10-year government space. And points to consider lastly, the world needs a paradigm shift. The current consumption, not sustainable. We can't just carry on consuming in this capitalistic way. So the planet Earth has finite resources, and this has come abruptly. Just things like our own civil liberties, our freedom, and the way we purchase things. Everything's covered in plastic and pollution, etc. We need to think about what we're doing. So we think environmentally funds, ECG funds, are going to become quite popular. And there's some other thoughts. Population growth and unequal wealth distribution will cause increased migration and friction globally. We can see it all over in the Middle East. We can see it all over in the world right now. Walls that Trump wants to build, massive immigration coming in from Zimbabwe and South Africa, etc. So South Africa has major challenges, unchecked illegal immigration and wealth disparities. This will, at some point, lead to civil conflict as unemployment increases. So we need to be aware of what's going on there. Globally, of course, capitalism is altered due to impacts of economies from the viral outbreak. Capitalism, as we note, is that the right model? I think people are questioning that. You can look at the US will be moving to the left. Maybe taxes will go up overseas. Maybe that Mr. Bezos doesn't need all those billions of dollars that he's made. Low interest rates may be lasting and are indicative of a troubled economy. I mean, they've manipulated interest rates in the developed markets to 0%. You get nothing. So imagine you going to a shop and getting nothing. When you put your money in a bank, you get nothing. How does that benefit? Yes, if you're a borrower, great. But if you're an investor, if you're a baby boomer with money in a fixed deposit and getting nothing, where are you going to put your money? That's the big question. Consumers' demand will come back slowly. That's the U-shape we were talking about, unless there's a vaccine for the coronavirus. And even then, we've got too many people on planet Earth consuming too many things. and we've got an equal disparity between the haves and the have-nots. Businesses will face compliance costs related to the virus. That goes without saying. I've got all my masks and sanitizers there. And then last but not least, stock buybacks and quantitative easing, that word for printing money. So while we printed money, look what happened. Germany, Second World War, printed money, look what happened. We print money now and there's no hyperinflation. It's rather bizarre. Two of the market's biggest drivers are the world's biggest experiments. So these are where we're sitting at the moment. We're not all, as I said, doom and gloom. Profit margins at corporations will revert back to the mean back at some point. Credit is cheaper than equities, that's for sure. You can borrow cheap right now. So maybe what our government should be doing is buying all that cheap oil and all the money that they squandered selling our oil stocks a couple of years ago in that whole big corruption case. What they should be doing is buying oil and stocking it up again at these record low prices. And certainly we can borrow from the World Bank very, very cheaply. So credit is cheap. And Warren Buffett, a white knight in the last crisis, is a bad side for the long. He's very quiet at the moment. Remember, our clients are not billionaires generally. We have wealthy clients, yes, but no one has billions and billions of dollars to play around with. For most of our clients, they're pensioners, they're retired people, they're people with their life savings. You've got to be careful where you do take the risks, as long as the risks are quantified and looked at. So we'd like to say the following words. To a big thank you to everybody out there. Ed and I are going to certainly be carry on contacting you. Behind the scenes, we're meeting with the fund managers. We're looking at the big macro picture and we're looking at the micro picture. We're finding out what's going on, and I think we've weathered the storm exceptionally well. If you look at our average client, as I said, they're either slightly up or flat for the last 12 months. So this coronavirus story has, although we didn't predict the pandemic, we've been planning for something like this for a while. So stay safe. God bless you and thank you for your continued support. We're here to help you at any stage. Take care.